My name is Andrew Palillo. I'm the Director of Member Strategies and Solutions here at the bank. Joining me today will be John Kornacki, another member of our team. And what we'd like to do, what the plan for today will be, is to go through the lens of managing a depository balance sheet, take a look at things that are happening in the yield curve and the economy. Also look at some key takeaways from second quarter call reports, and then also we are going to look at some balance sheet strategies that folks can be putting into effect.
So to start off, we're going to take a look at short-term rates. In June, the Fed made two technical adjustments to interest on reserves and the reverse repo rate. Interest on excess reserves went from 10 to 15 basis points, and the reverse repo rate went from 0 to 5 basis points. The Fed was concerned that Treasury bills might move negative as SOFR was hovering around 1 basis point. So with this adjustment, it provided some relief to Treasury bills. And as you can see, that provided relief across the term spectrum on short-term rates. LIBOR is the outlier here, with excess cash seeking any incremental income. Demand for investments like commercial paper remains high. And as the LIBOR days are coming to an end, I'll just say it, LIBOR is a made-up number anyway, so you have to take it with a grain of salt. So if you remember the last quarter's presentation, Andrew talked about reverse repo and why it matters even if you don't use it. Since the last presentation in May, volume has exploded. And what we're looking at here is, you see, it went from 400 billion then to now over 1 trillion. And then in July, the Fed announced the standing repo facility. With where things are today, it's like buying a snowblower on a 95-degree day in August. It's the opposite of what anyone needs right now, but it's something that you'll need later. And as there's been more talk of Fed tapering, so these actions that are put in place allows the Fed to prepare to remove themselves from purchasing $120 billion a month of bonds. And so what happens if the markets get volatile is that standing repo facility takes the funding risk off the table. As we'll discuss shortly, hopefully you bought longer term bonds in March, April, and May because longer tenors have come down. As you can see from the bottom two charts, the 5-year peaked at 97 basis points before making its decline, and the 10-year peaked at 173. There's been a bit of a bounce back off the lows in the past week or so, but with Delta concerns as well as questions around long-term growth, the bounce back has been limited. Then if you look at the top two charts here, you see the 2 and 3 year treasuries, and the experience with those rates has been very different from what we've seen with the longer tenors, and that's actually been a tick up with those rates, and really shows the sensitivity to Fed policy on the shorter end of the curve versus longer rates where the Fed has less ability to impact. And as the Fed commented more on potential rate hikes in June and the possibility of a hike coming sooner than expected with higher levels of inflation, you saw that the market priced that into the short end of the curve. So right now the market is still looking ahead to 2022 and 2023 as possibilities for rate hikes. So moving on to long rates now and inflation, you can't go to any financial news source today and not see the word transitory plastered everywhere. And I wonder if the Fed regrets ever using or introducing that phrase to us, as it's becoming a bit overused at this point. But anyway, there's a lot of data that people are tracking, as well as anecdotal stories around their experiences with inflation, whether that's prices of goods, the housing market, and the debate over whether it's a supply chain driven or infusion of cash from the Fed. It's a topic that will continue to persist for some time, and the Fed is committed to letting inflation run hotter for longer, and that's reflected in the break-even rates, as you can see here. The green line shows the nominal rates, and they have disagreed recently, and maybe due to the Delta variant and flight to quality. And frankly, the Fed would love to see a steeper yield curve if it can get there orderly. A steeper yield curve would make tapering an easier task for them because as the curve steepens, more investors will be willing to extend out on the curve and purchase those bonds that the Fed slows down in purchasing. But moving on to mortgage rates and spreads, like any asset, there is the compensation for rate risk, the spread over treasuries, and then there's the compensation for everything else. So, with fixed rate mortgages, you have prepay risk and you have credit risk as being the major spread components. If you look at this chart here, you can see the dots that represent 2020 in dark blue versus 2021 in light blue. And the spreads now versus last year are far less attractive. While treasury rates are higher, the mortgage rate is much the same, still hovering around 3%. And as we'll discuss in a bit, retaining fixed rate mortgages is a common theme from the last quarter, both in looking at the data as well as talking with members. And these strategies differ from member to member, whether it's trying to be opportunistic with spreads, monitoring gains on sale, rate driven, liquidity, or ALM driven. And there are pros and cons to all of these, but just in terms of historical spreads, these are much slimmer now than what is typical. So echoing my earlier statement, I hope you bought bonds in March, April, and May. This chart here is looking at the steepness of the curve and spreads on MBS. And the purpose here is to give you some perspective on where there's more compensation for either of those factors. So starting with the darker green dots on the bottom right, that's looking at the onset of the pandemic when the curve flattened and spreads blew out. So that value was capturing those wide spreads via matched funding and not having to take a rate risk mismatch bet. And as you can see at the bottom left of this chart, that shows mid-2020 when spreads narrowed along with a flat yield curve. So it's not surprising that cash built up on balance sheets as yields were not as attractive then. And then in Q1 2021, yields came back up and spreads widened a bit, but with it provided some relief. But as of today, you can see we're starting to drift toward lower incremental compensation here. And it's certainly difficult now when making bond purchase decisions. That you may have not noticed it, but if you actually look at the top right section of this chart, there's an X there, and that represents 2009 through 2015, which was coming out of the great financial crisis. So spreads were much better back then. And so as loan demand weakened, it was easier to buy bonds than it is today, for sure. And so the point being, we feel your pain, and the challenge is in trying to manage your bond portfolio in today's environment. Here's another example of excess liquidity and the Fed stabilizing markets. In this chart, we're looking at BBB and CCC corporate bond spreads which continue to show considerable strength, and these can be a proxy for commercial yields as well. But it's also worth noting, if you zoom in a bit to the most recent dates, you do see some movement up off the lows. You can't see it as well on the BBB line just because of the scaling, but those spreads bottomed at 107, and those lows were effectively floors, as you can only get so tight on spreads before it becomes unattractive as an investment option. So as these spreads have started to come back up a bit, there could be some negative price sensitivity in the near term, and spreads could continue to normalize here. So moving on to jobs and spending, this is an interesting visual here. It kind of illustrates the dichotomy of the comeback. So we're looking at payroll figures as well as retail sales, and you can see going back to 2018, both of these trended generally the same. And it makes sense intuitively, right? But then after Fed intervention and things started to pick up after the sharp drop, you see spending come up quickly, but then just totally blast through pre-pandemic levels. And payrolls have bounced back, but not quite back to pre-pandemic levels. And there's a lot of talk right now, where extended unemployment benefits are the reason why payrolls and unemployment have not returned, as workers aren't incentivized to get back to work. And I think that's the easy answer, but I also think I think that's the easy answer, and I do think it plays a part. But I do think the other major component here is that there was an additional 3 million people that retired early last year during the pandemic. So, and those folks might not be coming back to the workforce. So it's possible that the employment recovery may take longer than just a few months. And that's where folks, think about the impacts to longer term demand, supply chain, and everything else, within local and national economies. It's a bit of a wait and see on how this will impact members' regions as we continue to, try and push recovery. So the next two slides here are coming from the Senior Loan Officer Opinion Survey, and the Federal Reserve does this survey on a sample of large domestic banks as well as branches. So there are two sides to lending, right? Are customers looking for loans, and do depositories want to lend? And coming out of the pandemic, customers built up liquidity and had less of a need for loans. So you can see the large drop off mid-2020 across the major loan segments, with credit card dropping the most here. And then there really hasn't been a lot of progress until this latest quarter, where you see some sharp increases with CRE and credit card showing the strongest demand pickup. And then here's the lending standards side of things. So you basically see the demand chart flipped. Everyone tightened standards at the onset of the pandemic with so much uncertainty, and then slowly things have loosened up to where you see the significant moves this past quarter. So as demand has started to pick up, lenders are wanting to lend and grow their loan books. So it's hard to not talk about COVID with the resurgence and impact on the economy. I'm not a public health expert, so I'm not going to speculate on where things are going, and honestly, things are changing every day at this point. But one of the things that I think is at least positive in New England is the extremely high level of vaccination across our states. You can see on the chart here, the y-axis represents a percentage of fully vaccinated, and the colored dots show New England states. And when you do look at that data, that is helping us thus far. In this particular chart, I'm showing 7-day rolling average of new cases per 100,000, and that's just to adjust for population size. So fortunately, our numbers have been slower to tick up. Granted, southern states experienced the Delta wave earlier than New England, and we're starting to see things pick up here. But when you factor in hospitalizations, you see signs that the vaccination is helping to mitigate some of that spread and impact to folks. And we certainly hope that these upticks flatten out soon. Obviously, this is a major concern in the economy right now, and hopefully the fact that New England states are ahead of the curve, that will prevent further lockdowns and impacts to our local economy. So with that, I'll turn it over to Andrew to go through call report trends.
Thanks, John. So what we'll do is the first thing that we'd like to take a look at is cash levels. So when we look at what happened in the last quarter, we saw a departure from what has been happening over the last few quarters, in that amazingly, cash actually went down after reaching more or less historic numbers. So you can see the median credit union went from a little over 12% down to just in the 9% range, and with banks in blue experiencing a slimmer decline, but a move down nonetheless. Well, directionally it's going towards normalization, but still a ways to go to get back to pre-pandemic levels. So, one thing we did in terms of diving deep into the numbers is to see if, depending on how much cash members had. If there was a difference in terms of did the decline in cash come more from those who had the most cash, or from an average amount of cash, or a small amount of cash? And interestingly, the folks who had the most extreme cash levels, 15% and up, didn't decline as much as those who were in the 5 to 10 or 10 to 15% bucket. So I think we can attribute that to the business model and the approach for those folks who were on the extreme were more inclined to stay that way, as opposed to those middle of the road folks wanting to ratchet things down a little more aggressively. And you can see the higher green bars versus the blue bars is, like we said before, credit unions have been more aggressive in getting cash down. So if we ask the question, okay, great, cash went down, but why or how did that happen? We can see that first when we look to deposit portfolios. So here we're looking at the quarter-over-quarter change in non-maturity deposits for the last 2 quarters. Again, banks in blue, credit unions in green. So that dark blue line signifies what an equal amount of growth in both of those 2 quarters would be. So that we have more of the dots above that line tells you that growth in Q1 far exceeded growth in Q2. So in terms of normalization of cash, no matter what you did on the asset deployment side, you were able to take a pause from that hamster wheel of the deposits kept flooding in and were counteracting any of the asset deployment efforts. One thing to note, if you eyeball this chart, you see a lot more blue dots toward the right-hand side. So that tells you that for the second quarter, deposit growth was much stronger for your average bank versus your credit union. So in terms of getting cash down, you have less deposits to be deployed, but we also saw some more positive signs in a little bit of uptick in loan growth. So this is a busy set of charts here, but you can kind of get a feel for the direction here. And if when you zoom in later at the PDF, you can see some of the numbers. So going around the horn here, you can see in the top left, we're looking at loan growth, and we're stripping out PPP to kind of put that over to the side. And what we saw was loan growth was about 1 3/4%. So good, not great historically, but when you consider that 3 out of the last 4 quarters had negative growth for non-PPP loans, it certainly is a step in the right direction. In the top right, we have 1 to 4 family quarter-over-quarter growth. And as John mentioned, one thing that we have been seeing and hearing a lot is that folks are retaining more mortgages on the balance sheet. And that is borne out by looking at the data. And a continuation of the trend that we've been, again, seeing and hearing is that it's been the non-Boston and non-Boston adjacent geographies that have been leading the way. So when you think about COVID leading to a sea change in the idea of remote and hybrid work, that the northern New England states have been beneficiaries of that in terms of population migration. Bottom left looks at commercial real estate growth for banks. So certainly that is one way that many banks know that they can move the needle pretty quickly in terms of getting deposit down, given the loan sizes there, and positive numbers there. Not necessarily in line with some of the above average optimism we're hearing about pipelines and customer activity and things like that. So I think it'll take some time for that to fully filter through and to be evident in terms of seeing the big headline loan growth numbers. Rhode Island and Connecticut, for whatever it's worth, leading the way of the 6 states in terms of CRE growth. And then lastly, auto loan growth for credit unions. Autos, it's difficult. You really have to get them. We say this all the time. You have to get the originations cranking because of the short duration in order to see true growth. So it's been on the softer side over the last few quarters. but things have been trending at a minimum in a positive way. And Maine continues to be the outlier to the upside in terms of credit union growth for auto loans. So we mentioned PPP activity, and in the quarter we saw a lot of forgiveness activity. So here in New England with our members, from 23 billion at the end of the first quarter, balances made their way down to about 15 billion. So a decline of about a third. So I think the interesting thing to observe here is that you look on the right-hand side, the reporting is such that we know exactly how many PPP loans were written, and we know the balance amount, so we can figure out the average size of any one of those loans. And the size has been decreasing, so that tells us that the loans that have been forgiven have been, generally speaking, of larger sizes. So if you think about that and say that the loans that are left are smaller, so they're probably smaller businesses that maybe are still kind of digging themselves out of the hole that the onset of the pandemic put them in, and that the forgiveness may slow down. And when you think about, they're paying 1% on these loans in terms of access to credit. Historically, that is well below what any commercial enterprise typically would have access to. So the cost to carry this debt and take it further out really is de minimis when you think about it. So and I'm sure this is happening with a lot of our members. You're looking at the PP balances and you're trying to predict the future in terms of when they may forgiven and when they may translate into turn from loans to cash, and if and when those deposits may go away. I think the shrinking of the loan size suggests that these balances may be on the books longer versus shorter. So, continuing on this, how and why has cash gone down? Okay, well, deposits didn't explode to the upside. Loan growth has been pretty good, especially considering that there was a fair amount of forgiveness. The investment portfolio has been a mechanism to do that. So growth slowed down in the second quarter. So what we're looking at here is the quarter-over-quarter growth in the investment portfolios. So it's not too terribly surprising that second quarter growth paled in comparison to first quarter growth. And a couple of reasons why. Well, the first is that when something grows for 3 or 4 quarters, in order to achieve that same percentage level of growth, takes that much more in dollar terms. The second part of that is, as John alluded to before, the month of March saw a steepening of the yield curve and a welcome reprieve in terms of the available reinvestment yields that one could capture. So many banks and credit unions who were sitting on the sidelines with an awful lot of excess cash were able to deploy those at very attractive rates, and hence that growth in investment portfolio activity in the period. So, as the asset side of the balance sheet is adjusting, it's worthwhile to see what the interest rate risk profile of folks looks like, given some of those shifts. So, as we all know, interest rate risk cannot be boiled down to 1 or 2 metrics. It's a very complex process, but we'll try to use some things as a proxy for rate risk on both sides of the balance sheet. So, John talked about the retention of fixed rate mortgages. We haven't really seen a tick up in terms of loans and MBS greater than 15 years making their way onto bank balance sheets. So in terms of using up some of that asset sensitivity that has grown over the last year or so, as asset paydowns have shortened the left side of the balance sheet, and the core deposit growth has lengthened the duration of the right side of the balance sheet. It's really been on a selective basis. I think maybe this next quarter we'll start to see some of the tick up in terms of that chart on the left. And as we can see there, using the 1-year gap analysis as a proxy to give us some insight into rate positioning, we can see that what we just talked about, where the last couple quarters has seen a shift toward greater and greater asset sensitivity. So in fact, the bank who's in the 25th percentile right now in terms of the 1-year gap would, which would be, higher signs of liability sensitivity. Rewind back to December of 2019, pre-pandemic, and that same level of gap would put them more towards the asset sensitive side of things. So a pretty remarkable shift. Looking at a similar approach, but narrowly focused on credit unions, we have seen more long-term assets go onto the book. So you look at the trend on the left-hand side, looking at net long-term assets, we have seen a gradual tick up since March of 2020. And in fact, this last quarter really saw a quite significant jump higher in terms of those long mortgages and long MBS going onto the books. Interesting, though, despite those long-term assets, liquid assets are still trending higher. So, what's going on here is there's a little bit of a barbell approach, right? Where you're adding long assets, you're holding short assets, and really it's coming out of that space in the middle, right? Think about the auto loans and things like that. That is an interesting thing. And when you think about, a credit union who may be reluctant to add too much to the investment portfolio at these yield spreads or premiums, we've talked about this before, using a combination of cash and residential mortgages in a mix to your preference is a way to kind of build a synthetic mortgage-backed security, right? The loan by itself is too long. So you combine it with cash and you get to maybe that 3, 4, 5 year sweet spot where you'd like to be. So now we'll take a pause and we'll ask a poll question. We'll see as we jump into margin what folks think about cost of funds. So we're going to launch it here on the screen. So as of the second quarter of 2021, what percentage of FHLBank Boston members now have a cost of funds below 50 basis points? And you see the options there. And I'll give you a little bit of a hint in that the last pre-COVID quarter, that percentage was 15%. So we'll give it a minute or two for folks to get the votes in. No prizes will be awarded, just bragging rights. All right, I think we can close it up. So 48% of people said 77%, and congratulations, that is correct. So pretty incredible to think that in just a span of a couple quarters, a very small amount of members went from being able to have cost of funds that low to nearly the majority at over 3 quarters. So, looking a little more at margins and yields, one of the things that's been on the radar is that, yes, that ability to ratchet down cost of funds has been great in terms of mitigating some of that margin pressure. But we're really starting to hit a plateau in terms of what cost of funds savings can contribute. So what we're looking at here is the drivers of margin. So again, we took all our members and we put them into the various buckets in terms of what their margin did quarter over quarter. So whether their margin declined by a lot, by a little, whether they're flat, or whether they did see some small or large margin expansion. And then we want to see in terms of being able to increase loan yield or investment yields, or be able to lower cost of funds, what percentage of members were able to do one of those 3 positive things. So factors that may play into it. But what's really interesting to see here is that if you look all the way to the left in that minus 15 bucket, so even for those members who had the most extreme pressure on their margin in the quarter, 86% of those folks were still able to lower cost of funds. So really kind of without doing much or trying very hard, you were able to lower your cost of funds. But where the real difference maker is or was in fact the ability to redeploy assets at favorable levels. So turning cash into investments at higher yields, and even being able to scrounge around and find a sufficient amount of loans to combat the shrinking margin pressure there. And I think this is all the more important when we consider the fact of non-interest income is probably going to be tapering, no pun intended, its contributions to net income overall. So switching to credit side, again, we continue to see sunny skies relative to the storm clouds that were pretty prevalent going back into the early and mid part of 2020. So this is just looking at breaking it out by the various states, what the provision expenses were in the various percentiles back in the second quarter of 2020 versus the second quarter of 2021, and just by eyeballing it, you can see the amount of provisioning has scaled back pretty considerably, and you can see from some of those negative readings that the reserve releases have been pretty solid as well. And that goes to that last point about margin, that has been for what it's worth, some level of support for earnings, right? If you have been able to release reserves, but again, that's going to peter out at some point too. So that's certainly not as sustainable as strengthening the core balance sheet. So the last thing that we'll talk about, on this section here before John gets into a couple of strategies is, we've put together an index of all the public banks here in New England. So, it's not the S&P 500, it's the FHLBank Boston 37 or however many, banks there are, public banks. And, we plotted that in green versus the steepness of the Treasury yield curve from 3 months to 5 years, which I think is a pretty relevant set of tenors for depositories. And you can see, again, just from eyeballing it, they track pretty closely. So as the rise in bank valuations has occurred, it's coincided with the steepening of the yield curve. So I think, the thing to take away there is that shows you the fundamental asset sensitivity that is baked into the depository business model, right? You have your sticky, stable funding cost and the ability to get your assets out the door at higher yields and a steeper yield curve is going to be a positive for the earnings and the capital profile of the institution. And, even if you're a credit union or a mutual, we've said it before, it's important to see what the markets are projecting for the industry as a whole. And certainly here locally in New England, that is that much more important, so far year to date, because the M&A activity here in Greater Boston and in New England and specifically down in Connecticut really has led the way in terms of looking at it nationally. We've seen much more activity and much more activity on the large scale than really we've seen either in a long time or forever. So a lot of moving pieces to be sure. So with that, I'm going to hand it back over to John, and he is going to go through some strategies.
All right, so we're going to finish out with some strategies today. So as we've noted, between the tick up in loan growth, pause in deposit growth, and continued investment deployment, cash levels are coming down, but they are still historically high and weighing on net interest margins. if you look at the chart on the left here, you can see in Q2 the impact of excess cash. It's around 20 basis points for the median member. A lot of you may not be feeling that NIM pressure right now, and that's because there's some masking going on within your core balance sheet of mortgage gain on sales as well as PPP income, which has certainly helped out a lot of our members in the last year. That's going to slow down, and asset repricing is still compressing yields, and cost of funds reduction is stalling. On the right side, we're showing a hypothetical. If, say, you had a loan at 4.05% and a cost of funds of 33 basis points, and what that translates to in terms of available replacement cost or replacement options. On the asset side, to replace the runoff, you need a 30-year fixed-rate mortgage plus 115 basis points. For commercial, many members use the 5-year advance as the pricing benchmark. You would need plus 284, which is well above what we're hearing and seeing for high-quality deals where they're originating at right now. And for autos, you'd have to be moved down to the credit spectrum to clear plus 358 to treasuries. And then on the funding side, market rates are at or even below what's on the books right now. And for example, replacing existing funding coming off at a median cost of funds of 33 basis points with a 1-year classic advance, you'd actually lower your cost of funds there. So as you manage through these pressures, consider where there are attractive marginal reinvestment opportunities, and continue to manage those cost of funds down. As we mentioned, the combination of high liquidity and high asset sensitivity has led many members to hold more fixed rate mortgages. So folks are looking, at their pipelines, not liking the gains on sale, looking at their ALM position and saying, why not? The balance sheet can handle them, and this will help sop up excess liquidity. There seems to be more optimism around commercial pipelines. We've heard folks talk about, the pricing is crazy, but they're staying disciplined on credit, spread, and term. An option here is to explore the ability to use some of that asset sensitivity and maybe look at longer structures than maybe you historically have. And if you sell non-mortgage loans to other institutions, you should have the upper hand right now in terms of pricing. It's definitely a seller's market right now. And we've also heard, more folks looking at, non-traditional avenues like healthcare loans, for example. So moving down to investments, the first bullet here is saying, the amount to buy is a function of what needs to be deployed. There's so much runoff coming from, loans and investments that, buying a lot may only keep you flat. So, you have to determine, what buy a lot means to your institution. Avoid rate bets, but be opportunistic when it's in your favor. Think about how much you would have made if you deployed that excess cash in mid 2020. Even though rates were low, if your cash flows were short enough, incremental income was huge. So, and if you did buy bonds, how did you fare? If it was a 10-year MBS, 20% of your principal has already returned to you. You may have had a 1% price impact on value. But bonds are a risk reducing asset because the duration shortens as they pay down. Consider held to maturity and pledge. If you're still way below your target loan to asset ratio, consider using held to maturity to shield price sensitivity. That shield that price sensitivity that may have given you pause on purchasing that asset in the first place. And if liquidity is a concern, and if the asset is eligible, while you may not have pledged this in the past, you can consider pledging, much like you do with loans. So you now have off-balance sheet liquidity if you need it. And then lastly, deposits. CDs right now are a big opportunity. We see a lot of folks who have margin expansion possibilities, even in a sideways rate environment, where asset yields are pressured, and that's because the members have high CDs come rolling off right now. And when you have excess liquidity, that allows great pricing discipline to be, well inside the advance curve, where the advance curve serves as a proxy for, where you could click a button and get incremental funding. Lastly, this may sound a bit crazy as the biggest challenge right now is deploying those deposits effectively, but don't turn away the high quality core deposits that are the key to depository balance sheets. With marginal rates so low, that's when deposit rates are priced most unfavorably. So as rates go back up to 1% or higher, the value explodes in having those sticky, low-cost funding sources. So this is like business continuity planning for Treasury and ALM. While you may not see these types of moves we saw in March 2020, it's always good to have the game plan to be opportunistic for what you may want to do. On the charts here, we see the difference in spreads on some popular asset classes at the 2020 wides, or 2021 in the case of the curve steepness section, versus the present narrow levels we see today. In the heat of the moment, even if it's not the magnitude of March 2020, it's tough to introduce a completely new idea to ALCO or management. So get everyone educated and on board beforehand, so that if things do turn, you can act quickly when you need to. Same idea here. This may be off your radar now, but as markets change, conditions do as well. Watch for the special offering that we put out. We're keeping our finger on the pulse and highlighting ideas where there may be some appeal for you. Just a couple of examples here. Back in February of 2020, the HLB option advance presented some relative value as volatility increased, such that those rates were in the 15 to 20 basis point range, and NBS yields were at 150 to 175. And then you also, the other example here is the forward starting advance, which had a stretch recently in the last couple months where it became very popular as the curve flattened and pricing looked attractive. So keep those in mind as conditions change and specials are chosen based on where we see opportunities in the market. One thing to consider as we get into Fed watching with the taper as well as rate hike timing, the curve can tell us a lot of when the hikes may be coming and when rates are going to rise. So back in 2015, about 2 months out from the eventual first hike, the 1 month and 2 year Treasuries started to widen versus overnight Fed funds, essentially pricing in that first hike. And leading up to that point, funding on the front end, minimizing cost of funds, and extending assets if you can to combat the margin pressure offered a lot of value there. And easier said than done, but the trick is to extend liabilities before it's too late. So while there is value now in doing that fund short approach, the argument for extending liabilities would be the curve is much flatter now, so that cost of being too early is less impactful. For example, back in 2015, the 2 year Treasury was 60 to 70 basis points compared now to 23 basis points. So, whether with term advances or with a swap plus short advance strategy, you might be able to justify extending liabilities ahead of a possible steepening, especially if you've been adding longer assets, like fixed rate mortgages, for example. That being said, there are a number of options on the front end of the curve that can be cheaper than the 1 month classic. There are two varieties of floating rate advances that are pegged to overnight indices that are forecast right now to be at current levels through at least 2022. As an example, you can see the 3 month and 12 month SOFR floater at 20 basis point range, and the 1 year, 1 month DNA where you can prepay every month if you want to with no fee, and then you also have the 12 month classic advance, which is a fixed rate advance where we offered a special this week. Each of these options is 5 to 10 basis points cheaper than the 1 month classic. So with all these strategies and options, we'd be happy to dig deeper individually with anyone. So please reach out if you do want to dig deeper on this. So with that, I'll turn it back over to Andrew to close this out.
Thank you, John. Thank you, everyone. Just a couple of things to point out. Some member-centric things happening around the bank here. So we've recently rolled out a rates API available for members. So this is a way for you to get our rates outside of just our website or our online banking. Get it into Excel so you can incorporate it into any type of analytics or business intelligence that you're working on. So if you have any questions about how to work with that, reach out to your relationship manager, or in fact, John was part of the team putting that together. So, if you like it, let him know. If you really like it, then I was involved with it as well. The second thing there is we recently changed the email address where you receive our daily rate emails and advanced special offerings. It previously was moneydesk at FHLB Boston. It's now member funding. Again, reach out to the desk or to the relationship managers. They can give you the emails that need to be whitelisted, or even they have the IP addresses if that's something that your IT group would rather work with. And the last thing is we have our first in-person member meeting in almost 2 years. Registration is up on the website for the member golf and tennis and meeting in the beginning of October down in Barrington, Rhode Island. And we're happy to be able to get back in person and start to see members again. So with that, that's the end of the webinar. Thank you for your patience and your time. And again, if there's anything that we can be of help with, please feel free to reach out. Thank you, everyone.